With a lot happening in the financial market and investment buzzwords flying around due to market manipulation, stock prices volatility, and triggered buy-sell positions, you may be wondering if investing is risky or not. The reality is, investing can be risky, but the term risk depends on individual financial goals and objectives. The most common risks associated with investing include economic risk, political risk, and overall market risks. An average investor's worst fear is losing all their hard-earned money in investment opportunities gone wrong. This is a valid fear, however, we need to remember with risks comes returns. How risky an investment is comes down to different factors at play and what your risk tolerance is. Hi, my name is Darius Moika. I'm a senior investment advisor with Noor Private Wealth. If you are new to my channel, I focus on helping clients build wealth in the most tax-efficient way possible. And in this video, I'll discuss the factors that determine if investing is indeed risky and how best to manage an investment portfolio. So let's jump right in. What is the possibility of losing every dollar you have invested? Now, this question depends on how you have invested. If you invest in a single stock or company, for example, and that company goes bankrupt, you stand the chance of losing all your money. This type of investment risk can be classified as unsystematic risk, basically a risk that can be diversified away. To manage the risk of losing it all, you would be better off having a diversified portfolio of stocks across different companies, sectors, and asset classes. Investment diversification helps even out gains and losses in your investment portfolio while making expected returns. Owning a balanced portfolio of stocks and bonds in both domestic or foreign markets and across various organizations can be an effective approach to managing unsystematic risk. A second factor that affects investment risk is market volatility. Market volatility and uncertainties in the economy pose some form of risk for investors. However, investing in the financial markets can be profitable when executed with expertise. While there may be some fundamental backing to expectations in investment performance and returns, there is still the variability factor in returns. Volatility can be considered a systematic risk which cannot be diversified. Should you be worried? Well, that depends. If you are a short-term investor or frequent trader, then maybe. The volatile prices would definitely get your stress levels on the high side. A highly volatile investment can have you earning so much in capital gains in 1 second and losing significantly the next second. However, for long-term investors, this somehow evens out in the long run. If you do not make the mistake of overtrading and overreacting to temporary market swings, your investments can pay out in the end. I discuss more about this in the How to Invest and Actually Make Money video. You have the link right here. Market volatility further leads to compensated and uncompensated risks. With compensated risks, you can expect to make future returns from systematic risks that are accounted for in a stock's price. This is like compensation for investing in specific instruments. On the other hand, uncompensated risks do not offer additional return expectations. They are mostly faced by risk-loving investors. An example is putting a lot of money into a single company stock or a single sector. The outcome could go either way. Again, with diversification, you can effectively balance out the compensated and uncompensated risks in your portfolio. If you are extremely risk-averse and skeptical of incurring losses, saving cash in a general savings account may be a safer option, but you could miss out on opportunities to earn higher returns, generate investment income, and build wealth. Alternatively, in order to avoid losses and manage market return volatility, risk-averse investors can opt for guaranteed products such as guaranteed investment certificates or invest in fixed return bonds. However, they would face the risk of inflation. Investments in these seemingly safer assets may be more prone to inflation risk as their returns are relatively lower. Think about buying a home with $500,000. Back in the 80s, this would have been enough for a stunning property by the water, whereas now this would hardly get you a one-bedroom condo. The fact remains that financial markets are often cyclical and come with inherent risks. There's the risk of inflation eroding your real returns, and market risks of volatility in prices and returns. However, in the long term, periods of booms make up for troughs and financial losses. Your investment objectives, risk tolerance, and personal status influence your investment decisions. Depending on your investment horizon, risk appetite, and returns expectations, you can invest through different investment options such as the stock market, mutual funds, index funds, real estate, government bonds, and bills, amongst others. Remember, diversification is key, and so is adopting the right investment strategies. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button. And if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.